Now, you might not realize it with all of the hype surrounding technology rivals such as Facebook and Apple, but one of Silicon Valley's giants is in the midst of a stock slide. That's right. The shares of Google are down more than 18% year to date. Well, my next guest thinks maybe this is a time to buy. Michael Harkins is a partner and president at Levy Harkins Company. And if you had an account, just an average account at Levy Harkins last year, your portfolio grew by, well, 27%. We'll call it 30%. We'll round up for you. Good to have you with us, Michael.
Thank you very much. I hope the SEC sees it your way.
I'm just going to see the 27%, the actual returns. So Google, down 18% year to date, and you say, don't worry about which way the big market is going. You can't predict the future, but you can take a look at a company that's got a lot of cash and a real business.
Yes, and some of those points of those loss I've actually endured. So thank you very much for the kind intro. Yeah, Google is emblematic of so many big-name high-tech stocks in the United States these days, in that you're getting a giant cash hoard as well as a thriving business. And investors just haven't learned exactly how we're supposed to value that cash hoard. So let's use Google as an example. They have $37 billion in marketable securities. It's going up by more than $1.5 billion a quarter. And think for a moment how they got here. They didn't borrow this money. They didn't sell a division. It isn't left over from an IPO. This is money they actually earned. Okay. In a $155 billion market cap and with no debt, $37 billion is a big part of the equation. Right. If you then subtract that from its $480 near closing price, it's $120 a share. So you get to buy something for, and I'm doing a sort of Ben Graham thought experiment.
That's all right, doing the value.
It's a thought experiment.
Yeah.
All right. But you're creating a stub for $360 that will earn $31 a share this year, and we're halfway through this year. You're looking at something closer to $37 or $38 a share next year if it continues to grow at its accustomed rates. And of course, the cash just keeps building up, so the discount to that just keeps getting greater.
All right, now let me pose to you the challenge, though, which is that you've got to get other people, not you necessarily, but other investors have to see either the rationality of that argument or the wisdom of approaching an investment in that way for that valuation to rise. It doesn't just rise all by itself. Someone is going to have to bid up the price and recognize the cash, recognize the $35 to $38 a share in profits, and also recognize the fact that they got a real business.
Yeah, and that's the breakthrough idea of The Intelligent Investor, Ben Graham's seminal book. You're right about the process, but you're wrong about the way to think about it. Because if you just come in every day and say, does this make an awful lot more sense? And is this cash hoard getting bigger? Is this cash flow getting greater? Is it coming at me like a fire hose? Believe it or not, you do better through time because there's a zillion antecedents. There's a zillion things that can happen that will make people more appreciative. You can't name them all sitting here tonight. You can name whether you'd rather do this than buy a 10-year Treasury at 2.9%. And you'd much rather do this. And by the way, maybe the government will grow sensible. I see even union presidents like Andy Stern are urging on the American government to stop being so foolish about overseas cash and letting American companies repatriate
it. Repatriate the money, yes.
At a low tax rate.
Right, and that would bring some of that money back that Google has because a lot of it's been growing overseas.
It would be a share repurchase to be remembered.
So why is it that it seems that it's almost difficult to convince most investors that just doing this simple math is more intelligent or profitable, to use the intelligent investor theme, profitable than going out and buying 10-year government bonds, because that's what they've been doing?
Yes, and you are innocently asking that question, but of course the reason is because investors are confronted every day with a torrent of news. I mean, it starts from the dawn and it goes on into the late night hours of everything other than that. What's most important about investment? What's most important about investment is the price you pay. Everything else fades into the background if you paid the right price.
So tell me about Greece and how this creates almost that backdrop of fear that gets people buying a 10-year Treasury for under 3% when they could be buying stocks.
Yeah, and it's
certain stocks.
It's near to madness about this because we are going to literally paper over this problem in Greece. Okay? You could let Lehman Brothers fail. This is the analogy that's always being used.
Right. Is Greece the new Lehman Brothers? Right.
All right. You could let Lehman Brothers fail, cause an enormous amount of pain, particularly in the 10 blocks around us right this minute. But at the end of that, it was done. Greece defaults, there's still 11 million people living on a rocky outcropping right next to Central Europe.
And they have to eat.
They have to eat.
Right.
And all logistics people know, the remarkable thing about food is it's always in the wrong place. So you have to move it. So they need to import fuel to move it, and they need food. And that problem doesn't go away the day after you default. In fact, it gets much more intense.
All right, so having said that, should we worry about what's going on in places like Greece, in Portugal, in Ireland, potentially in Spain and in Italy? Or have we just become fixated because it seems as though it makes theoretical sense that everything's going to collapse, when the opposite would be more profitable to pay attention to companies that are actually making money?
Well, one thing, we need to be so much more creative in how we're fixing these what's called a pig problem, the peripheral problem. This is what I think Soros was getting at yesterday. And the great problem is Greece has been in default for more years since its independence than it's been in compliance. It was once in default for 53 years in a row. We shouldn't be threatened by Armageddon.
All right, we're talking about markets, the economy, and also some stocks that may stand to benefit if you take a contrary view, if you take a look at value. My guest is Michael Harkins. He is a partner and president at Levy Harkins Co. Last year, the average account at Levy Harkins gaining about 27%. All right, now, Michael, just to continue the conversation, because you were talking during the break about the implications for Greece, the euro, the ECB, the European Central Bank, and you were saying that the thing right now is that the European Central Bank, its future,
in an untenable
has
position.
painted itself into a corner.
They believed in their own, propaganda. And so in the course of the last year, and it's about exactly 12 months, they have bought up 40 billion euros of Greek government debt. They have also lent to the Greek banks, which would not survive today without this lending. They have lent them 80 billion euros on Greek government paper, just the way the Fed discounts treasury bonds that JP Morgan Chase might want to repo. Okay, it's the same thing with the euro, except the European Central Bank can't lose anything like 120 billion euros. It can't lose 50 billion because its equity capital is only 10. And Jean-Claude Trichet has gone from being an independent arbiter here to the worst, most vulnerable participant in the whole crisis. He, of course, is the equivalent of the Ben Bernanke
right.
of Europe.
But I mean, isn't that the whole point of these international financial institutions? They're the ones to absorb the body blows when you have a problem like Greece. Now it seems as though we're focused more on saving the ECB than we are focused on saving Greece.
The lifeguard has wound up with too many people to tow to shore all at once. And he starts worrying about his own health rather than, I mean, there's an analogy.
Well, you were also describing that maybe what ought to happen is that the Germans, if they don't like the situation with the European Union, and particularly with the euro, if they don't like subsidizing the Greeks, maybe what the Germans ought to do is they ought to be the ones to leave the Eurozone.
Yes, and every German opinion survey will show you that the German public would love to have its Deutschmark back. And since there are 17 countries in the euro right now, if one dropped out and revalued its currency upward, that would not be, I'm almost certain, a credit event that would touch off these credit default swaps, which are a completely unknowable risk. Okay, the Germans would be happy with that. The German car industry would take a bit of a knock, but the rest of the countries of the ECB don't have big car industries, and it would just do in so many problems all at once. But it's almost unthinkable politically because we need so much more creativity about this than we're getting.
And what we do is keep papering over the problem with real money, and you say that's a reference to Weimar Germany. It's like a repeat.
It is scary thinking about how bad this inflation could get out of hand. And I'm sorry to throw brickbats at the authorities when they're busy trying to solve a problem. But just endless creation of more paper is not healthy for society, and it's dreadful for capitalism.
All right, well, what's good for capitalism? We talked about Google. I want to give you 30 seconds. Tell me about Caterpillar.
Well, Caterpillar Tractor is emblematic of what's going on here. Caterpillar is so profitable at lower revenues than it had 3 years ago when the boom was going on. It will earn $4.5 billion this year compared to the $3.5 billion it earned when it was employing more people and putting out more orders and giving orders to its suppliers. More profitable now than it was then.
All right. I want to thank you very much, Michael Harkins, Levy Harkins, Google, Caterpillar. Wise words about the euro. Thank you.